So this is actually the second time I'm presenting on Dean Manne's work. I did that 2 years ago at George Mason University on the honor of his book, Insider Trading on the Stock Market, that was published in 1966. So I guess either I am the only person that can appreciate the true value of his textbook, or everybody likes French people. I don't know which one is it, but I hope it's only because everybody likes me. So I'm going to try to summarize and reflect on Professor Manne's contribution to the literature on insider trading and his impact on the law and economic and finance community. So let's think first about how insider trading was perceived in the literature before Dean Manne wrote his book, and I think he also was his dissertation as well, or he wrote his dissertation at Yale on that topic as well. So before 1966, insider trading, which is defined broadly as the use of non-public information in a securities transaction, was actually subject to more moralistic, emotional approach. It was everything. Look, somebody is selling, using a private information that not everybody has to make a profit, and that's unfair, and it's not moral, and it's not right. Dr. Dean Manne talked about his lectures when a student was stomping on the floor and said, "I don't care, it's not fair." And I actually had the same experience. I was teaching a class and I was lecturing on insider trading, and all the students were looking at me and they're saying, "We don't care, it's not fair." I'm like, okay, what is fair? And they say, "I don't know. Fair is what I pay when I take the bus. That's all I know about fairness." So one of the things which is great about one of the pioneering work thing in Henry Manne's work is that he tried to bring a rigorous, logical, analytical, scientific analysis into studying insider trading. In other words, his approach was the debate has become completely emotional. It's all about how I feel. It's not about how it is. There is no real economic analysis. So he used economic analysis to try to rigorously study what is insider trading. And you can have one big argument why Dean Manne supports insider trading. First is that insiders should be considered as entrepreneurs. And they're entrepreneurs on the stock market. When they trade on inside information, which means non-public information, their transactions tend to move the price toward their true value. It improves the informational efficiency of the stock market. In other words, their transactions guides less informed investors toward reallocating capital toward more valuable lines of production. And therefore, when they trade on inside information, the price of the stocks becomes more accurate. Obviously, there has been a lot of literature on the topic, and a lot of people that did research on the effect of insider trading on the stock prices say, well, that's not totally true, because insiders will tend to try to hide the transaction. But what those scholars forget is that insider trading is illegal. So if it's illegal, of course I'm not going to try to trade on the stock market and tell to everybody, look, I'm selling stocks with inside information, or I'm buying stocks with inside information. I'm going to try to hide my transaction, and therefore insider trading won't have as much effect on the stock prices. On the other hand, if you accept Dean Manne's argument that if you were in a market where insider trading was unregulated, you will assume insiders will be more willing to trade in open markets, and therefore the transaction will be more informed. And one of the aspects that Dean Manne emphasizes that when you allow insider trading, you allow insiders to convey information about the firm without disclosing information that might be crucial for the competitors. when you talk about trade secrets, you can trade on those information, but you don't disclose those information about impending takeovers or impending mergers or new product with coming. The second point, and Peter Klein talked about it a little bit, is that and he was already in the 1966 book, as well as his most recent paper that Dean Manne sent me, which is Entrepreneurship, Compensation, and the Corporation, is the idea that insider trading could be used as a compensation scheme to reward the entrepreneurial activities of insiders. When you read the work of Dean Manne on this topic, his thinking has slightly evolved by incorporating more and more some of the Austrian ideas. In 1966, he clearly emphasized the idea of entrepreneurship. It's only my own interpretation, actually, from a Schumpeterian viewpoint. But after, in the later years, there's more Austrian, Kirchnerian, Hayekian, Misesian understanding of entrepreneurship. But one of the key things I read in the paper is that maybe we should not define insider trading as a compensation scheme, but more as a system. The idea, it is different to consider insider trading as a compensation scheme because contrary to all the compensation mechanisms like bonuses, pay raise, and stock options, you do not have a necessary immediate guarantee that by trading on inside information, you will gain the full value of your innovations. Right? And the additional aspect that is in this paper is that by prohibiting insider trading, you prevent smaller size corporations to be able to compete with larger size corporations for the entrepreneurial skills of managers of other type of entrepreneurs within the firm. Because sometimes smaller firms cannot compensate those entrepreneurs at the same level than big size corporations. And in his paper, he discussed this idea why we have those huge salaries and compensation in large corporations and so different from smaller size. And one explanation possibly is the fact that insider trading is illegal. And maybe those big corporations or smaller size corporations will use insider trading as a system to reward entrepreneurs for their entrepreneurial activities, whether those entrepreneurial activities are discovering new ideas or information or opportunities or create products, etc., etc. Now, I would like to talk briefly about the influence of Dean Manne on the law, economics, and finance community. Well, first, one can say his book was not very well welcome. If you look at a lot of book reviews, and I read a lot, they were quick to dismiss this idea of entrepreneurship as insider trading as a possibility to reward entrepreneurship. They were also quick to argue that, contrary to what Manne says, that small investors tend to lose out of insider trading when they buy stock from insiders. And if the stock goes down, they are losing because they bought the stock. And their response is, well, whether the insider was there or not, they would have still bought the stock. It doesn't matter. Alright? So, I made a slight search on what the insider trading literature is now. And there's about 200 to 300 references just in US on insider trading. There are about 200 to 300 papers that have been published. When I make a search in 2000, there was about 300. There's about 40 to 50 US dissertations that are now the topic of insider trading. Before Dean Manne wrote, there was not much literature on insider, and even less among economists and finance. Much less. There was pretty much nobody. I think one of the great contributions is that whether or not you agree with what Dean Manne says, everybody that was opposed or in favor of insider trading was forced to think more rigorously about the topic. If you look at the literature on insider trading, you have more economics than there ever was. And you have more empirical research on insider trading. And with the advance of econometrics, there have been an improvement in trying to assess the desirability of insider trading. There were studies on whether insider trading improved market efficiency, informational efficiency, what is the impact of insider trading on the bid-ask spread, right? On the market liquidity, on the cost of capital, on price accuracy, on ownership concentration, on transaction costs, market volatility, bankruptcy rate. There has been even public choice analysis of insider trading, right? Unfortunately, when you look at the literature, and Dean Manne says that in his last paper, I thought I was done with the topic. And it's like suddenly, well, maybe I was not done. Because apparently nobody is still investigating some of those crucial questions I think we need to answer. And when I look at the analysis, there's a lack of consensus. And one explanation is that empirical research has been growing a lot. But the problem is that when you do a lot of data mining, you can end up with finding statistical significance with everything. I have my plug. Thanks.
Yeah, but I don't care about your
Okay, fine. Nobody cares about the French anyway, so. Let me say there's three important questions that I believe have not been answered yet. A lot of literature is emphasizing that insider trading is inefficient, therefore we should regulate insider trading. This literature tends to ignore, first of all, the huge amount of literature that says that insider trading laws are not effective. But they never question this most important question. Is this regulation efficient? Are the benefits worth the cost? If you spend billions and billions of dollars on regulating insider trading and you catch nobody, virtually nobody, and there's no real data that shows that when you prohibit insider trading, stock markets are more efficient and more liquid because the empirical research cannot take into account of all the possible factors, it doesn't matter. And ultimately, the arguments are, well, improve the investors' confidence in the stock market. Investors are not more confident on the stock market because there is insider trading laws. If you look at surveys, people think insider trading is prevalent on the stock market. The last survey since Martha Stewart, people were saying, yes, obviously there's a lot of people that trade on inside information. What can we do about it? Nothing. There's another question, and that's going to be my last point, is, well, two other questions. And one, nobody's talking about a competition as a discovery procedure. Hayek used to talk about competition as a discovery procedure. When you allow competition, you can allow firms or securities market to discover what are the most efficient institutional rules. It is possible that if you want to attract a lot of capital, you ban insider trading. But maybe some stock markets will decide to allow insider trading and people will still invest in the stock markets. Right? The idea that you will discover by allowing competing systems what are the most efficient rules and mechanisms that will promote the allocation of resources most use value. Finally, there is the work of Henry Manne on insider trading as a compensation mechanism. Henry Manne has done a lot of work, but nobody else has really investigated seriously. Can insider trading be an effective system as a compensation for entrepreneurship? Particularly, you can imagine again the idea that you will allow firms to decide or not they want to allow insider trading in their firms, and you could decide whether or not investor will invest in it. You will have this idea of competition as a discovery procedure, and this idea of local knowledge. Different firms will use different systems based on the local knowledge of those people. All right, thank you.